Welcome to week 3 in our Finance 301 class. This week we're going to be looking at both chapters 5 and chapter 6 of our textbook. Chapter 5 covers the topic of the Federal Reserve. Proverbs 22 and 7 teaches us that the rich rules over the poor and the borrower becomes the lender's slave. According to Will Rogers, there have been 3 great inventions since the beginning of time: fire, the wheel, and central banking. I'm not convinced of the greatness of central banking. However, there is no denying the potential effect that the nation's central bank, the Federal Reserve or the Fed, can have on the economy through its effect on the supply of money and credit. Through this effect, the Fed alters the supply of money and interest rates. Keep in mind, there are other factors that affects the supply and cost of credit, besides just the Federal Reserve. These can include the fiscal policy of the federal government, the political environment, the saving habits of individuals, and the expectations of inflation or deflation. So let's begin our look at chapter 5. The role of the Federal Reserve. The purpose is to control the supply of money and credit. It conducts monetary policy to promote stable prices, full employment, and economic growth. And actually, as you will see in some of the other videos that I've posted, and please make sure you watch those, that the main 2 purposes of the Federal Reserve is for prices, stable prices, and full employment for the citizens of the United States. And it also serves as the lender of last resort to counter shocks to the money supply. The structure of the Federal Reserve. You have the Board of Governors, and this consists of 7 people that is appointed by the President of the United States with the confirmation of the Senate. And these appointments are for 14 years. The terms are staggered so that one new appointment is made every 2 years. The chair of the Board of Governors is usually the major spokesperson for monetary policy and may act as an advisor to the president on economic policy. Then there are the 12 district banks. So the United States is divided into 12 districts with the Federal Reserve Bank in each district. Each district bank is managed by 9 directors, 3 of whom are appointed by the Board of Governors, and then the remaining 6 directors are elected by member banks and represent the member banks' industry, commerce, and agriculture. And so by dividing the nation into districts, it helps and makes possible that the individual reserve bank performs specialized financial services pertaining to its region. And then there is the Federal Open Market Committee, or the FOMC. This is part of the Federal Reserve that establishes and executes monetary policy, and it has control over open market operations. The committee, the FOMC committee, consists of the 7 members of the Board of Governors and 5 presidents of the district banks. The president of the New York District Bank is a permanent member of the committee, while the other 4 remaining positions rotate among the district bank presidents. And so here, figure 5.1 shows us the Federal Reserve structure. So the President of the United States appoints the Board of Governors. The Board of Governors then appoints 3 directors for the 12 district banks, and then member banks elect 6 directors. And so then the Board of Governors and then the four elect representatives from the 12 district banks on a rotating basis make up the FOMC, or Federal Open Market Committee. So reserves are a percentage of banks hold against deposit liabilities. Monetary policy works through its effect on banks' reserves. Banking is organized under a system of fractional reserves. Transactions that put reserves into the system will lead to the expansion in the supply of money and credit. Transactions that take reserves out of the system cause the supply of money and credit to contract or decrease. So, let's say that an individual goes into a bank and they deposit $100. And the reserve requirement is 10%. So $10 of that $100 is kept in a reserve, and then the other $90 is in excess reserves. Now, these excess reserves are important because commercial banks uses these to acquire income earning assets such as writing loans and securities. So that other $90 is then lent out to an individual. That individual then takes that $90 and goes, buys things, and that money, that $90 ends up in another bank. And then again, there's a process that just keeps going on. And as you can see here, the first bank has the $90 in excess reserves. Then they, to the second bank, there's that process of the borrower and seller, and it's a continuous process throughout. So, if a bank depositor withdraws $100 from an account, what happens to the reserves and the deposits? Reserves will decrease by $100 and deposits will decrease by $100. When cash is deposited into an account, new excess reserves are created and lead to the expansion in the supply of money and credit. There are certain assumptions in order for this to work. Cash is always deposited in a demand deposit account. Banks hold no excess reserves and all excess reserves are loaned. And there are sufficient borrowers to consume the excess reserves of the bank. So, here goes into more detail of what I was talking about. Someone goes in, they deposit $100 into a demand deposit. Then $10 is required in reserves, and then $90 for excess reserves. Then that person takes the $90, that goes into a second bank. And so there's a new $90 credit created. And then there's $9 held in that for reserves, and that increases the required reserves to $19, and then the excess reserves is to $81. And as you can see, as it goes through, what ends up happening is that $100 can create $900 worth of new credit. Now, I know that on this scale, that doesn't seem like that much, but when you're talking about billions of dollars that is exchanging and taking place, then you can see how that affects the supply of money in the United States. If a bank lacks sufficient reserves, it can borrow reserves from a bank that has excess reserves. The federal funds market is a market in which banks borrow and lend excess reserves. And there's a federal funds rate. This is the interest rate that is charged by banks on overnight loans of reserve. So what you've got to understand and remember is that when a bank borrows money from another bank that has excess reserves, this is typically on a short-term basis. So it's not looking for something long-term. It's something that is relatively quick, and it's just usually in cases of emergency. And then there's the discount rate, and that is the interest rate charged banks for borrowing reserves from the Federal Reserve. So Exhibit 5.2, multiple contraction of in the supply of money. So if someone withdraws $100 and we still have that reserve requirement of 10%, and remember that reserve requirement is set by the Fed also, and they can adjust that as needed, and we're going to get into more of that in some of those other videos that you're going to be watching this week. So that $100 is withdrawn. There's a change in the demand deposits. $100 is gone. There's a change in a cumulative change in demand deposits of $100. And then there's a reduction in the required reserves of $10. And so as you go through, it's the reverse of what we seen a minute ago. And so when that $100 is withdrawn, it can create a cumulative change in demand deposits of a negative 900 and a cumulative change in required reserves of negative 100. There are three primary tools for affecting reserves: the reserve requirement, the discount rate, and open market operations. And the Federal Reserve has selective credit controls concerning loans and the margin of requirement. So the reserve requirement. A change in required reserves alters all banks' abilities to lend. So if there's an increase in the reserve requirement, so it goes from 10% to 15%, it decreases the bank's capacity to grant loans. An opposite happens if there's a decrease in the reserve requirement. So instead of being at 10%, say the Federal Reserve reduces that to 5%, then now they have an increase in excess reserves, and the bank has the ability to increase the amount of money that it can lend. For example, if we go back to that deposit of $100, if it's a 10% requirement, then the bank has to hold $10 and it has $90 that it can lend. Whereas if that increases to 15%, then the bank has to hold $15 in reserves and it can only lend $85. Whereas if that if the required reserve is decreased to 5%, then the bank only has to hold $5 and now it has $95 that it is able to lend out to borrowers. The Federal Reserve establishes a target rate that it wants to get the economy to. And the Fed uses open market operations to achieve the target rate. Open market operations is the buying and selling of U.S. Treasury securities by the Federal Reserve. So here in figure 5.2, we see the target of the federal funds rate from the year 2000 through 2022. You can see that it's an fluid percentage. It got to a high of 6.5%. During the recession, you can see that it drastically decreased down to almost zero in 2009 and stayed that way for about 7 years, from 2009 to 2016. Then it gradually began to increase. Then COVID hit, and once again hit reduced from 2020 down through part of 2022, and then it's been on the decline, on the increase once again after we've came out of COVID. So then we have open market operations. That is where the Fed buys and sells federal government securities, and it is by far the most important tool of monetary policy. The Federal Reserve may buy and sell securities at any time and in any volume. If the Federal Reserve seeks to expand the money supply, it purchases securities. If it seeks to decrease the money supply, then it sells securities. And so when the Federal Reserve seeks to contract or reduce, it sells those government securities. And once again, it is the payment for the purchased securities that alters the money supply and the capacity of banks to lend. The total effect of these transactions is to, one, decrease the money supply because demand deposits are decreased, and then to decrease the total reserves of the banking system because banks have fewer reserves on deposit in the Federal Reserve. Sales of these securities increase interest rates. When interest rates increase, it also increases rates on your mortgages, on your credit cards, and so therefore it takes more money than before to purchase a home or to use those credit cards, because now the interest rates for each of those have increased because through the sale of government securities. The effect of fiscal policy on credit markets. So, the fiscal policy, even though the Federal Reserve can affect the supply of money and credit in the economy, it does not have complete control over them. Fiscal policy is the taxation, expenditures, and debt management by the federal government. Like monetary policy, fiscal policy can be used to pursue the economic goals of full employment, price stability, and economic growth. Like monetary policy, fiscal policy can affect the supply of money and the capacity of the banking system to lend. Taxation or government expenditures by themselves do not alter the money supply. However, when government expenditures exceed revenues, it creates a deficit, and this deficit must be financed. When government revenues exceed expenditures, the government must do something with the surplus, and the surplus is when the receipts exceed the disbursements. It is the financing of the deficit or the disposing of the surplus that may affect the supply of money and the capacity of banks to lend. If the federal government runs a deficit, it may obtain funds to finance the deficit by borrowing from the general public, banks, the Federal Reserve, and foreign investors. If the federal government runs a surplus, it may retire debt held by the general public, banks, the Federal Reserve, and foreign investors. In either case, a deficit or a surplus, the securities markets and the banking system are not immune to the fiscal policy of the federal government. Sources to finance the deficit: commercial banks, non-bank public, Federal Reserve, and foreign credit markets. So here we have 4 different cases: borrowing from the general public or retiring debt owed to the general public, change in money supply, there is no effect, change in total reserves of banks, there's no effect, and then change in excess reserves of banks, there's no effect. In situation 2, borrowing from banks, there is an increase in the money supply, no change in total reserves of banks, and a decrease in excess reserves of banks. If they retire debt owed to banks, which means they pay that debt off, there's a decrease in the money supply. There's no change in total reserves of banks. However, the change in excess reserves of banks increase because now the banks have the money that they had borrowed plus the interest that comes in, and now they have more money to lend out to other borrowers. In situation or case number 3, if they borrow from the Federal Reserve, there is an increase in the money supply, an increase in total reserves of banks, and an increase in the excess reserves of banks. If they pay that debt that they owe to the Federal Reserve off, then there's the opposite effect, and there's a decrease in money supply, decrease in total reserves of banks, and a decrease in the excess reserves of banks. In case number 4, if they borrow from abroad, from foreign countries, then there is an increase in the money supply, an increase in the total reserves of the banks, and an increase in excess reserves of banks. However, again, the opposite happens when they pay that debt off to foreign countries. There's a decrease in money supply, decrease in reserves in banks, and then a decrease in the excess reserves of banks. The effect on inflationary economic environment on credit markets. So what we look at here is the word inflation. And if you have watched the news a lot lately, there is talk about inflation. In fact, inflation had risen in 2022 by 9%, which was the highest single year increase since 1981. And so inflation is a general increase in prices with a special emphasis on the word increases in consumer prices. So when we say an increase in prices, or prices are what consumers pay to obtain goods and services. It can also mean what producers must pay for plant and equipment, but when we're using it in connection to the word inflation, we are talking about the consumer price increase and rising. And so inflation does not mean that all prices are rising, but that the prices of most goods and services are increasing. The prices during inflation, the prices of some goods can fall while most other prices are increasing. Inflation is frequently expressed as a rate of increase in an index. The index that is most often used is the Consumer Price Index, or CPI. Changes in the CPI are usually expressed in percentages such as 3%, meaning that the prices as measured by the CPI are rising annually at a rate of 3%. So, as most of you, I hope, know, inflation has occurred virtually every year for decades. On average, it's roughly from about 1983 through 2021. It was an annual rate of increase of about 2.7%, which means that if your wages did not increase by greater than 2.7%, then you were not able to keep up with the prices increase, which means that your dollar didn't go as far. So, for example, if, like we just stated, that the CPI has indicated that inflation has risen by 2.7% every year since 1983 through 2021. If you only got a yearly raise of 2%, then the amount of money you were bringing in did not match the increase in prices, and therefore your dollar doesn't stretch as far. Whereas if you got a 3% raise, then you were staying above the curve and your money was going further. And so what a lot of people are talking about now with inflation over the last couple of years, especially since coming out of COVID and the last couple of years, what has happened is, for example, like I stated, in 2022, inflation approached 9%. If you were only getting a 3% yearly raise, then you were falling behind by 6%. And this is where we run into consumers are talking about when they go to the grocery store, what used to cost $100 is now costing $150 or $200. And so they're not able to keep up with the increase in the prices of goods and services. Deflation is a rare occurrence. It doesn't occur very often. Deflation is a general decline in prices. Deflation is rare and can lead to decreased economic activity and increased unemployment as buyers defer purchases in the hopes of waiting until prices are lower. So it's a general decline in prices. It has the opposite impact from inflation. Unexpected deflation hurts debtors and helps creditors, and it's associated with higher levels of unemployment. Because again, if people are not buying uh, uh, goods and services, then companies have to start laying off people because they have to reduce their costs and overhead and what goes into setting the price for those goods and services. A recession is a significant decline in economic activity across the economy. There's an increase in unemployment and a reduction in the nation's level of output. And we have seen different periods since World War II ended in 1945. There have been 12 recessions that have been identified by the NBER. These 12 recessions have ranged in duration from 18 months, which was the 2007 through 2009 recession caused by the financial crisis, all the way to 2 months, early 2020, due to the COVID pandemic. The average of those 12 recessions have averaged about 11 months. Until 2007, the economy had experienced few recessions and they were relatively short and mild. However, the recession experienced from December of 2007 through June of 2009 was the severest economic downturn since the Great Depression of the 1930s. And again, remember, we have talked about this. During this recession, people lost millions and millions and millions of dollars, and suicide rates increased during this period of time because of everything that was going on in the economy. To combat this economic environment, the Federal Reserve bought securities, lowered interest rates to historic lows. Simultaneously, the federal government pursued an expansionary fiscal policy and ran deficits that were primarily financed by the Federal Reserve buying the government securities. So, they can also use non-conventional policy tools that include quantitative easing, which they done. So, one of the things that our textbook talks about on pages 81 and 82 is it talks about how the Federal Reserve used quantitative easing. So prior to 2008, the Federal Reserve held less than $1 trillion worth of securities. However, by the end by late 2021, the Federal Reserve's balance sheet was nearly $9 trillion and rising. So you can see from that period of time that started in 2008 through 2021, it went from less than $1 trillion to over $9 trillion. Figure 5.3 shows us the dated recessions since World War II. So you had 1950, then there were two others in the 1950s, in 1960, then there wasn't another one until 1970, another one in the mid-70s, two that were early on in the 80s, one in the 90s, and everything kind of relative till that 2007 through 2009, and then there's that recession again was the greatest since the Great Depression. Figure 5.4 that shows the assets of the U.S. Federal Reserve, and again, we talked about it being less than 1 trillion. Now it's it's approaching 9 trillion. As we conclude chapter 5, what is deflation and what are the effects of deflation? As we talk, deflation is a general decline in prices. Lower prices imply lower costs of goods sold and increased profits for some firms. Lower prices can also imply decreased revenues and profits for other firms. Deflation is rare, but it can lead to decreased economic activity and increased unemployment as buyers defer purchases in the hopes of waiting until prices are lower. I have posted 2 videos that also goes along and correlates with chapter 5. Please be sure to watch both of those. Then also listen to the lecture on chapter 6 and make sure you are responding to your discussion posts. Be sure, as a reminder, that when you are doing these discussion posts, you create your initial post. Then you have to respond to at least 2 classmates' posts to get full credit, the full 10 points. I hope you have a blessed week.